Hi, I'm Steve Dudash, IHT Wealth Management. Welcome to this week's Wealthcast. All right, I'm getting this question over and over and over again every week for months now. So I kind of wanted to talk about it. I think we've talked about this before, but wanted to get it out there. And that is the trade war, how the cycle of what's going on with the trade war affects your portfolios, and what it all means. And we've got a nice little chart that we're going to put up here. We did not make the charts. We've got it from someone else, but it's very nice, and it helps illustrate this endless cycle that we've been in. And that is, it usually starts with our administration saying we're going to get tough on trade, and we're going to put a bunch of new tariffs out there, and then China retaliates, and the markets drop on the fears of the trade war escalating. And then a couple weeks or whatever later, we're like, well, we're going to ease up our threats on some of these trades, tariffs. We're not going to do quite as much, and I think we're going to be able to work out a deal. And then all of a sudden the market snaps up, and then we talk, and nothing happens. And then we go back a few weeks later, a few months later, and we get tough on trade again. And this cycle goes over and over and over and over again. And frankly, it's getting old, but stop believing the hype. Stop believing the hype when they say they're going to get tough and how bad tough these tariffs are going to get, and the markets go down bad. That's not real. It's all fake. This is just big economic posturing by two of the biggest countries, economic countries in the world. And then when they say things are getting better, no, they're not. We're in the same spot. We're not working out a deal, not anytime soon. So don't believe that big snap up. And then when they do talk and nothing happens, don't be surprised. Don't get caught up in the cycle. What you can do, though, is because the cycle's been going over and over and over again, it's pretty predictable. And so when you see the bad tariffs coming back out again, that's your buy signal. Markets go down 2 or 3%. If you have cash, if you're sitting on extra positions, that's when you buy in. And then the flip side of it is when you see a big pop, don't get too excited about your portfolio jumping because the tariff war is going to end, because it's not anytime soon. So don't get too high on that end and too low on the others. Just get used to this cycle. It's part of what this administration does. It's part of the world. We got the two biggest economic powerhouses in the world right now trying to work out a deal. Of course there's going to be misinformation. Of course there's going to be, acting tough on both sides. That's how a big negotiation works, because whatever they do negotiate, it's probably going to be in place for a couple decades. So it's not going to happen overnight. But take advantage of it. You're sitting on cash, you see the bad press, go after it. Because it's going to snap back up. There's no other way of saying it. So hope all that helps. And frankly, all of this cycle stuff has helped keep interest rates low for longer. So we can have a whole nother debate on whether that's good or bad, but we'll talk about that another day. If you have any questions, call me, email, text. We will try to reply to as many of these as possible. Have a nice weekend. We'll talk.